Okay, so in the first hour, we talk about what can go wrong between firms and the society. Now let's talk about what happens between firms and financial markets. So in an ideal world, we believe that maximizing shareholder value works when the markets are efficient and convey accurate information about the stock. So whenever you see the price, it reflects the true value of the stock. And we believe in this world, we believe that if a CEO is taking good investments, then the value of the stock will be really high. And all those good projects will return to the company as increased shareholder value. Also, with short-term accounting gimmicks, you cannot increase the market value of the firm. Stock price performance is a good measure of company performance in general. So this is what should happen in an ideal world. What goes wrong is this. First of all, of course, managers know more about the company than we do. They're the insiders. They know about the company very well. And whenever they know about whenever they have new information about the company, they can time when they're going to reveal this information. And also, they can give misleading information as well. There is a quote, there's a very nice quote. It says, if you want to figure out a person, don't pay attention to what he says, pay attention to what he doesn't say. So sometimes, and this is important for you in your daily life as well, in finance news as well. Just try to read what is trying to being hidden by the CEOs. So we have asymmetric information. We said that, and also whenever there is new information told to the investors, to the public, investors may overreact. And we saw that with like Apple, for instance, like iPhone 6S. Was it like a true genius product? No, it was the same thing. It's the same thing over and over again. But you see the market reaction. The stock price increased like crazy when they announced the new product. And investors are very short-sighted. They care about what happens like in the next month or so. So because of that, they might overreact. They can be very irrational as well. So they can, instead of using the information they have, they go with the gut feelings, let's say, which is irrationality in academic terms, basically. And also, if the markets were efficient, we shouldn't have market crisis. If everything reflects its true value, there shouldn't be crisis at all. Think about the latest crisis in U.S., 2008 crisis. There was a real estate bubble, let's say, and existence of bubble is all about markets not being efficient. Why? If everything reflected its true value, there shouldn't be a bubble. Bubble means the prices went up, the value was this much, the price went up, and then at some point it burst. So now people are talking about the real estate bubble in Turkey. What do you think? Do you think we have a real estate bubble in Turkey? Huh? Not yet. Did you see, yesterday it was on Hürriyet, the countries with most increased prices of real estate list. I think Turkey was number 6 or so. So house prices are increasing like crazy. You see all the shopping malls, everything, luxury housing built everywhere. Lots of people, majority of people believe that there is a housing bubble for sure and it's going to burst. Some people compare the numbers with other countries and they say, no, we're fine. I believe there's a bubble and I believe lots of things are accumulating and it's going to burst at some point, for sure. And the global conjecture is also not in favor of Turkey for now. So things are getting really hard, harder and harder every day. So be careful about your investments and If I were you, I wouldn't spend like crazy amount of money all the time. Just try to save for bad days.
Loan every time.
Taking loans, interest rates are not bad as of now. Like the mortgage rates are 0.88 or something, which is pretty low. I remember it was 1.2 or something 4 years ago. But of course, one point for that is people don't have money to buy houses. So of course, the interest rates are going down for that reason as well. Yes.
But they are making so long time periods instead of the last years. Last years they are saying it's only 10 years.
Uh-huh.
But in these days they can say 30 years and this kind of things. But the thing is, America did this. But after this, how can I say, attack, we see what happened in America, and I believe that the same thing will happen in Turkey.
Actually, I read an article which also compared Turkish economy with the American economy before 2008. There are lots of similarities with that. So my point is, be careful. And luxury housing, it's not the time to buy luxury housing. Probably the prices of $100,000 Turkish lira houses will not go down, but there are lots of $1 million, $2 million houses around, and I don't think it reflects their true value. So I would just stay away from them for now. Just wait. But anyway, so markets are not that efficient because we see those bubbles everywhere, in every century. Tulip bubble, you know, it was, remember, 18th century? Lale devri. There was a huge crisis. The tulip, the seed of tulip prices went ridiculously up. And it was part of like Turkish, our fault, not our fault, but our effect, of course, because we were selling tulips as well. So there are bubbles in almost every time. And we had the recent one in US. Let's see whether we will see it in Turkey. Okay, so going back to class. So as a markets, what are the responses related to lost market efficiency? One is now it's so easy to have access to information. So when there's an announcement, the effect of the announcement takes place within 5 minutes. It's ridiculous. So the CEO is making some announcement in 5 minutes. Everyone in the world is getting the information and reacting to it, and you see this in the prices within 5 minutes. It's ridiculous. You heard about high frequency trading? We had a guest a month ago here from US. They are like trading with milliseconds. They're using this delay in information, milliseconds, and they're making money on that, like through connections and cables. You're losing time because of the connection and the cables and everything. Even when they can catch this, they make tons of money, and it creates huge value. So all the information is revealed very quickly, and everybody in the world knows about it very, very fast. Option trading is very common. So now companies are more okay with giving bad news, because even with bad news, there are lots of people who can make tons of money. We're not going to talk about options in this class, but there are lots of financial instruments. So if you expect bad things to happen, you can buy options on this future potential bad things and make tons of money as well. I have a friend, we graduated together. I heard that like in a month he made like $80,000 with option trading. You know, like it's so easy to make money. Of course, he's very smart, of course, but information is there for all of us actually. But you have to spend lots of time and effort to find to figure out what's going to happen. Also, there are papers, academic papers, which show that in finance, academia and industry goes hand in hand. So we analyze data and we write papers, and CEOs take from those papers as well. So one study showed that if the CEOs have some bad news, he should give that bad news all in once. So it's not like, oh, let me just talk about a little bit of it today, and next week I will tell a little bit more about the bad news. No, the market reaction is more severe when you do it. Instead of this, if you have a big pile of bad information, just give it to the public, take the hits in the market, then improve from that. So managers are doing that. Another thing is when companies have bad information, do you know when they give the bad information to the public? The timing, the week of the day of the week? Friday? What time? Just after the end of the market. So they're timing when they're gonna give bad information as well. Because if you hear it Friday evening, probably you're not gonna react very soon and irrationally. You're gonna wait during the weekend and then do whatever you're gonna do on Monday. So people are timing when they're giving information. And you cannot mislead the market all the time. Everything is so common, so transparent now. So a CEO cannot fool you all the time. Not you. Maybe they can fool us, but they cannot fool the market like Wall Street all the time. Okay, let's move to two more relationships, which one will be between shareholders and debt holders. Huge conflict. The other one is shareholders and managers. Again, huge conflict. And this is what we see in the real world all the time. So I think these are interesting topics. Before going into that, let's just go over principal-agent problems and what is agency problem, why it is called agency problem. So basically, in this world, there's a principal, and principal hires an agent. And there are some conflicts of interest between principals and agents. And the easiest example is someone, like if I want to sell my house, I'm hiring a real estate agent. I'm the principal. I'm hiring a real estate agent so that she can sell my house. So in this world, there are problems. Why? Agents' interests are not always in line with principals' interests. Like I'm a principal. I have the house. What is my interest? Sell the house at the highest price possible. What is the agent's interest? Sell the house as soon as possible, right? So this is the easiest example I can think of. Here I have an interesting thing. When I was in US, I was watching this reality show on real estate agents. In Malibu or New York, they're making tons of money because they're getting fees. And every time they make a sale, of course, they have a commission. One interesting thing is there was this little guy, he's like 19 or 20. He's a real estate agent from a very rich family, but he's an agent as well. He's sitting with his grandmother. His grandmother is, 90 years old or something. She's been through a lot. She was in Germany, then she came to US. And they made all that money because she was wearing like nylon stockings. Kadın çorapları var ya. Ne deniyor ona bizde? Normal şey. Külotlu çorap diyoruz. Okay, yes. Thank you. Thank you, Ayşe. And then okay. And there was no stockings in US at that time, and she just produced it, and they made tons of money. They're really rich. Anyway, they're sitting together, 90-year-old guy and 90-year-old grandma, and he got a phone call. He was devastated. He said, "Oh my God, I'm so sorry." And apparently his friend, his like 8 years old friend, this little guy's friend, he died. And he was really sorry because he said, "Oh, we were very close." And his grandmother said, "Oh, that's good. He died, so you can sell his house." So this is the real estate agent's interest. Sell the house as quickly as possible. Because they are putting lots of money on advertisement. Like maybe they're not doing this in Turkey yet. Maybe they do. I don't know. But like they actually bake cookies in the house. They have an open house, like Saturday from 2 to 4. Anyone can come see the house. They bake the cookies there because apparently the fresh baked cookies that smell make people want to buy the house. They're thinking lots of things. They do all the arrangements, everything. Lots of effort. So for them, selling the house as soon as possible is the most important thing. For us, sell the house at the highest price possible is the most important thing. So this is an agency conflict. Let's go back to finance, and we're going to talk about two kind of principal agent problems. One between stockholders and debt holders. The other one is between stockholders and managers. Let's start with stockholders and debt holders relationship. So in this relationship, who do you think is the principal and who is the agent? So we have the shareholders and we have the debt holders. This is a confusing relationship, so let's see whether you will figure it out. So shareholders are owners of the company. Debt holders are giving money to the company. In this relationship, who is the principal, who is the agent? It feels like it, right? But it should be the opposite, yes, but why? It is
because the stakeholders own the owner is stakeholder.
okay. Actually, this is the confusing part. Why? In this case, you can think stockholders and managers together, because stockholders hire managers, right? So you can think this relationship between as managers and debt holders. If you think managers and debt holders, who is the principal, who is the agent? Debt holders are the principals. Debt holders are like the principals because they are lending the money to managers so that managers can use that money to create value and return it back to debt holders. So in this relationship, debt holders are the principals. They have to be paid back. They're giving money, but they will take it back with some interest. And they're hiring managers, kind of. They can't. Debt holders cannot hire managers. But the feeling is it's almost like they're using those managers so that managers use that money to create value and return the money with the interest to debt holders. So what do debt holders care about? They care about safety. They want to get their money back. They want to get the interest back. They don't care what the CEO is doing there, but they just want their money back. Now, managers who are working on behalf of shareholders, now managers and shareholders are together, they're close friends. Shareholders think about the upside potential. What is that? Remember we said shareholders have limited liability. So shareholders cannot lose more than they paid for the stock, which is like a sunk cost. They already paid for that anyway, right? So even if the company goes bankrupt, they just lose their sunk cost, let's say. But if the stock price goes ridiculously up, we make tons of money. So we don't have the downside risk that much as shareholders, but we might enjoy the upside potential so much. Because it doesn't matter the stock price is whether 50 or 1,000, debt holders will get the fixed money back. There's no upside potential for debt holders. Stockholders, on the other hand, just the opposite. As the stock price goes up, we're happier. Do you see? Can you follow me? Okay. So maximizing stock return may harm debt holders. So the CEO might take investments which are very risky. Risky is bad for debt holders. They don't want risk. They want their money back, that's it. But the CEO can say, okay, I'm going to take lots of risk. If I win, I'm going to win big. And in that case, stockholders will be very happy. So stockholders are okay with risk because they are waiting for the upside potential. Debt holders don't like it. So this is the main agency conflicts between debt holders and shareholders. One example I can think of is FedEx CEO. FedEx was in trouble. The owner of FedEx said, I'm going to go bankrupt for sure. So what am I going to do is, I'm going to take all the company money. I will go to Las Vegas. I will gamble. He did that, and he won. And he saved the company. Gambling is bad. Okay, for our audience, gambling is bad. But this is a very good example of agency con. Debt holders were dying probably. You know, like the company has a little bit of money left, and debt holders are going to take that money because they are in line first when the company has money. But he says, I don't care, I will take the money. He gambled. Think it as very risky investment. He won. He returned the money, shareholders were happy. It is risky investment, exactly. But the house always wins, okay? So don't forget about it. Do not gamble, it's bad. Okay, let's go over this example. Very simple. Think very simple, okay? Don't ask me like very complex questions on this. Take it as simple example. Not very realistic, I know, but it is very demonstrative. A firm borrows $100 at 10%, is choosing between two projects that cost $100 each. So I'm borrowing 100. I have two projects. There's project A, project B. Project A pays $111 for sure. Project B has 50-50 chance of paying $90 or $115. They cost the same. The only difference is they both cost $100. The only difference is certain investment, uncertain investment. This is 50%, this is 50%. So what do you think about who will prefer which project? Yes?
Shareholders, I think they will prefer the A because
So you said B. Yes, shareholders will pick B. Very good, very impressive. And debt holders?
the gain is much better than the A.
Very good. He's right, thank you. And debt holders will choose A because there's no risk. Very good, very good. Exactly. So, of course, I will show this to you with some calculation. But in each case, how much money should be returned to debt holders? 110, right? $100 is the capital, 10% is the interest rate. 110 should be returned to debt holders. Can you follow this one? No question. Perfect. So in each case, you have to pay 110 to debt holders. So from here, debt holders will get, oops, sorry. Oh yeah, I can write it. Okay, debt holders are getting 110, and this money goes to shareholders, equity holders. Perfect. In this case, how much money debt holders will get? 90. They should get back 110. There's no 110, so they will get 90. How much equity holders will get? Why did you, 0. No? How come? Okay, here, 115. If the project makes 115, how much money debt holders are going to get? 110. How much equity holders will get?
5.
Let's calculate the expected values, right? Because there's an, if this happens, they will take this one. If this happens, they will take this one kind of world. So with 50, what is the expected value equity holders will get? Let me see whether you know what to do here. So if the equity holders, if project B is taken, how much equity holders expect to gain?
$5.
Thank you. 2.5. They will either get 0 with 50% chance, or they will get 5 with 50% chance. So actually, equity holders will get debt holders. expected value debt holders will get?
100.
100, right? 90 or 110. So as you can see, which one is better for equity holders? This one is better. This one is really bad for debt holders. Why? Because, first of all, there's a possibility that they will not get all the money back, which is really bad for them. And their expected value is 100. Instead of 110, they can get here for sure. Equity holders, they don't care about that. They don't care about that 0. They're going after that 5, and their expected value is 2.5. So in this world, as you can see, debt holders they don't like risk, and equity holders are okay with risk if they believe there will be upside potential. Yes.
Is it sustainable for the shareholders?
They don't care about sustainability that much. No. No, I mean, okay, here's the thing. When I say risk, a CEO cannot have a sustainable term in the company if he's taking risky projects all the time. But maybe 1 or 2 times he can do that. And a good CEO is a CEO who can take risks, who has the good gut feeling. So even people say, no, don't go after this. If he's going after it and if he makes money, he's a very good CEO. But if he's not very good, of course he cannot go with. Even someone who is always good at picking risky investments, at some point people will say, hey, okay, this is giving us a heart attack. Just take it easy, boy. So it's not very sustainable.
Asking about the bank, can bank, Türkçe sorsam olur mu?
Sure, we will translate.
Banka mesela
Oh, he says the bank says no. Okay. Yeah.
Banka işte anlaşma yaptı diyelim. Sadece A koşuluyla sana parayı vereceğim diye bir şey söyleyebiliyor mu?
Thank you. Yes, he can. Okay, so are banks stupid? I should say no, since I'm the daughter of an old bank executive. No, banks are very smart. So if they believe that a CEO might act this way, he can put some covenants in the agreements. They can restrict investment. They can say, okay, you can also spend that much of money. That's it. Like, I don't know, $500,000. That's it. They can say, they can put restrictions on dividends. They can put restrictions on leverage. The only thing, and my paper, actually I have a paper about it, CEOs are more informed about the nature of investments, the riskiness of investments. So maybe they can translate some kind of, they cannot, okay, the bank cannot say you cannot pick this project. No, they can't. But they can say you cannot spend lots of money. They can do that. They are not the managers of the company. But the managers, since they have more information, they can pick risky investments and show it as like a more secure investment if they would feel like it. So in this relationship, they have limited, let's say, limited say. The debt holders have limited say on what managers can do. But yeah, they put covenants. They try to use covenants. Other types of conflict, risky part is easy to understand. Another conflict might be increasing dividends. If the CEO wants to increase dividends, it is good for what kind of increased investments favors which stakeholder? Who gets the increased dividend? Shareholders. Why can it be bad for debt holders? Why do they care? The CEO says, I'm going to increase dividends. Shareholders are very happy. Why are debt holders not happy with this? Okay, suppose that I borrowed money from you guys and the feast is coming, Eid is coming. So I decided to distribute lots of money to my cousins. Why would it be bad for you? I have to pay you back just after Eid, for instance. I will pay you the money with the interest, for sure. But I said I'm going to distribute money to my cousins. Now I have to. It's taped. Okay. Why is it bad for you? Very easy answer.
There is no guarantee. The bank cannot get money.
Exactly. The bank would prefer me keeping all the cash in the company. Why am I paying it to my cousin? Why am I paying it to my shareholders? So, of course, debt holders prefer cash in the company. They just want to be sure that they will take their money back. Do you have something? Yeah.
I want to ask a question.
Sure.
I believe that the banks want to that you cannot pay money back. I believe that banks don't want to pay your money back. They want to, how can I say, they always want to, you have a...
Restructure their debt, so you will always owe to the bank.
Yes.
Okay.
Never wants to pay back.
My dad would have a heart attack if I tell him that. No, they want the money back, of course. They don't want any credit to go missing. And they do the restructuring only if the person is in trouble. I mean, in a well-functioning market, this is what should happen.
I'm not talking about the bank situation, but for example, you are a well-known brand and you are lending money from a bank, but you cannot pay it at the time. Banks always want that. Because if you cannot pay that, they can control your business. They can do what they want.
Okay, this is really risky for a bank. If everybody is like that, and it's very increased risk is crazy in the story, do you think banks will be okay with it?
They are not giving money to who is near to bankrupt. They are giving, for example, Apple. They know that they cannot.
Okay, okay. Of course, in that story, Apple is the customer of a bank. So banks want to keep their customers, but they want the customers to be healthy, right? They want to make sure all the time that the customer will be able to pay back the money. Money that is not paid back to the bank is a huge liability for the bank. And the financial markets overall. If lots of banks go bankrupt, everyone, farmer amca, çiftçi amca, everyone will be affected. So I will disagree with you in that story. Okay, I will still disagree with you. There's no discussion. Okay, but yeah, we will talk about it later. So increasing dividends is bad for debt holders because they want cash in the company, but shareholders will want dividends. Taking riskier projects, we talk about it. So basically, when a bank is giving you money, it's all about the current riskiness of the firm. If the firm decides to take more and more risky projects, then what's going to happen to the cost of capital? Remember, if riskiness increases, what happens? What happens to the return expectations? You expect higher return. Higher return means higher cost of capital. So for those companies, cost of capital should increase. High-risk companies will find money from banks at a higher interest rate. So cost of capital for them will increase. And in that world, it's going to be a problem because the bank is giving you an interest rate based on your current riskiness level. Then you're increasing riskiness by taking risky projects. In that case, bank will be in trouble. And the last one is borrowing more on the same assets. So this is what happens basically, maybe kind of related to what you said, maybe. So you give some collateral to the bank. You say, okay, I'm going to pay this back. If I can't, you can take my factory. You can have an agreement like this with the bank. But then if the company is in trouble, then they can use the same asset to borrow more money. In that case, the value of the factory is fixed. The debt on the factory is increasing. Again, high risk, which is bad for banks. To protect themselves, what do debt holders do? We talk about covenants. They put covenants on the debt agreements. They say you cannot distribute lots of dividends. You cannot get more leverage. Leverage is debt. You cannot have more and more debts. They say, let's restrict your investments. You cannot spend lots of money for investments. They can secure debt by asking collaterals. They say, okay, if you have land, if you have a factory, we're going to take those as collaterals. And if you cannot pay off your debt, we're going to take your factory. They do that. And they issue convertible debts. It is part equity, part debt. So basically what they do is they say, okay, whenever we want, depending on our agreement, we can convert our debt to equity. By doing that, debt holders become equity holders, actually. So it's a way to protect themselves. And of course, the most important thing for the companies is our reputation. If a company is known in the industry that they cannot pay off their debt, then its reputation will go down for the company. It's going to be harder for them to find additional money. Even if they can find money, the interest rate will be like crazy. So this is the relationship between debt holders and shareholders. In this relationship, who is the stockholder? Who is the principal? Who is the agent? This is easy to understand. Stockholders are the principals, exactly. They are hiring managers to manage the company. Shareholders own the company, as we said before. Managers run the company. CEOs, chief executive officers, they're the head of the main person who manages the company. Shareholders can elect board of directors. They have one voting right for each share, and we can vote on the important things. We can pick the chairman of the board. We can pick the board of directors. And board of directors oversees the managers. So in every company, there's board of directors, there's a chairman of the board, and there's a CEO. Sometimes CEO is also the chairman. It depends, but most of the cases he's not. And the main reason why we have directors in the board is hopefully they're going to monitor the managers. So if the manager is acting crazy, the directors should say, hey, you're doing things wrong. Let me read this. Probably you don't see it, but this is from GE's 2010 annual meeting notice. It's a real letter. Basically, it says GE's 2010 annual meeting of share owners will be held at the George Brown Convention Center, Houston, Texas, on April 28, 2010, to address all matters that may properly come before the meeting. Following a report on GE's business operations, shareholders will vote on the election of directors, vote on ratification of the selection of the independent auditor. You know, companies have independent auditors for extra monitoring. They will vote on shareholder proposals, blah, 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 blah. So every shareholder is getting a notice from GE like this. So you can go to the meeting, listen to the meeting, but probably GE has billions of shareholders, probably 100,000 shareholders. Probably not all of them will go to Houston, of course. But basically it says you're invited to attend. If you plan to attend, please follow the advanced registration instructions, blah, blah, blah. If not, then it says you can ensure that your shares are represented at the meeting by promptly voting and submitting your proxy by telephone, by internet, or by completing, signing, dating, and returning your proxy from in the enclosed envelope. So you're invited to the meeting. Even if you can't go, you have the voting right, and you can use this voting right through phone, email, whatever. Let's see what happens, though. Most stockholders don't go to the meeting. They don't use their votes. And whenever you don't use your vote becomes the manager's vote. The existent manager is using your vote, basically. Large stockholders generally agree with the management. Okay, large stockholders are the ones who actually have a kind of a say in the management of the company. Big pension funds, hedge funds, they have tons of money in the companies. And they own huge amount of shares from those companies. And those people are close buddies. They all, I don't know, they live in they work in Wall Street. They live in the suburbs in New York. Their kids go to the same school. They're friends. and they're the main players of the financial market. So they generally agree with whatever the management says. And this graph kind of shows that there are big mutual funds families, and as you can see, 90% of the case, they support for the manager resolution. They support the manager. Only like 30% of the case, they support shareholders. So we have a controlling rights, but we cannot control managers as much as we want. With the board of directors, what can go wrong? Normally, board of directors are not the guys of CEOs, but they should monitor CEOs. The CEO often, they pick the directors. So a 1992 survey revealed that 75% of companies relied on recommendations from the CEO to come up with new directors. Directors don't have lots of shares in the companies. So directors should be protecting shareholder rights and shareholder wealth. But since they are not shareholders and since they are picked by CEOs, they don't do their jobs. And also, this is very interesting that there was a recent study about it as well. It's called connectedness. What was it? Board of directors connectedness. It's really funny. The CEO of one company is a director in another company. The director of that company is the CEO of this company. So again, it's a very close circle. Those people are protecting themselves, actually, and protecting their relationships. And because of that, board of directors are not doing their job that well. That's why I think we have this rule as well. In US, every director should have independent directors. Directors who are not directly related to the company. They should be independent so that they will monitor the CEOs. The main shareholder and manager agency conflict comes from the fact that managers have different incentives. So once the CEO is picked, we don't know what this guy is doing in his time. We don't know whether he's in his office working for you, working for the company, or he's not in his office and he's playing golf. You have no idea. So even this is an agency conflict. You want this guy to work all the time so that your wealth will increase. But they don't. They're golden parachutes. These are really funny. These are really golden parachutes. When the CEO he gets an offer from a company, he signs an agreement, of course, a contract. And in his contract, he can put, in case of fire, not fire like fire, if you fire me, you will give me, I don't know, $50 million. He puts it in his contract, and it's called golden parachutes, actually. Like, it's legal. It's part of the contract. And they use it all the time. It's against shareholders' interests because you don't want this guy to be so bad that he's going to be fired. But he doesn't care because whenever if he gets fired, he's going to get $50 million. He doesn't care. Another thing is empire building. CEOs are like sultans, actually. They like building in their empire. They want to manage big companies. The bigger the company is, the bigger their reputation will be. So they might go around and buy lots of other small companies, even if it's not a good thing. So this is a bad thing for shareholders because the CEO is taking bad investments. The value of the company will go down. Another thing is luxury spending. Even the office furniture they use, if they're spending, I don't know, $30,000 on a piece of table, it's bad for shareholders because it's not going to increase the value of the company at all, unless the CEO says, I need this table. I'm going to create lots of money. But they do it. If a company is not managed very well, the company might be the target of a merger or a takeover. So I see another company. It's a good company, but the CEO is stupid, and he's taking bad investments all the time. In that case, I, as a company owner, I might go buy that company, which is bad for the CEO. It's actually good for their shareholders. target shareholders are very happy with the takeover in general. Why? They're getting rid of the bad management, and they know that the value of their company will go up once it's a takeover target. What do CEOs do? They put anti-takeover devices. They put poison pills in the structure of the company. It's again legal. So it's a device that will basically kill the company if another company decides to take over their company. Or what do? When there's a takeover probability, they make a deal with this acquirer company who's interested in their company, and they say, okay, you can pay me less if you put me in the board of the new company. A study actually also showed that. It's also legal. It's bad for shareholders because shareholders will get less value from the takeover. It's good for the CEO. CEO is basically is buying a seat in the new board in the board of the company. So that's another problem. What do shareholders do to align their interests with managers? They put performance-based compensation. They say, okay, you're going to get a fixed salary, but on top of that, we're going to link your salary to the stock price. So if you can increase the stock price of the company, your compensation will go up. It's win-win, right? It's good for the company. It's good for the CEO. Does this work? No. Actually, my professor in Iowa, Eric Lee, found a case, and it was a big deal. He made the Times 100 most influential people list that year. It was a huge deal. And he basically showed that CEOs are also using their power, let's say, to manipulate this. I'm not going to go into how it is done because we have talked about options and stuff. But if you're interested, just Google Eric Lee and you will figure it out. Also, shareholders try to put outside independent board members in the board. They have shareholder activism. What they can do is they can basically use their proxies to go against the current management. Institutional investors are really influential. We have 5 more minutes, and I'm going to use 4 more minutes. I'm going to use all of it. They're also using their power on the management as well. And I'm going to show you just a couple of interesting things. I think it's very interesting. I'm going to look at the compensation part only, just show you a couple of interesting things, and then you can go. JP Morgan CEO over worker pay table. So in 1890s, a CEO was taking 20 times more than an average worker. In 2010, he was getting 343 times more than an average worker. CEO salaries went up like crazy. If you look at the wage growth in the 20 years from 1980 to 2002, workers' salaries increased by 75%. CEOs' salary increased by almost 2,000%. So the CEO pay for an average S&P 500 company is $11,000. So you're going to say, do they deserve it? They deserve it. They're creating lots of value. I'm not after their salaries. If they're creating value, I'm fine. It's okay. But does it translate into what shareholders are getting? I will just show you this example, and I will let you go. That's very interesting, but this happens all the time. This is Pfizer. You all know Pfizer. It's a big company. They hired McKinnell as a CEO in 2001. Okay? Here, 2001. And here there are 2 lines. Probably you don't see it very well. One is for the market return. The other one is Pfizer's return. We are comparing how Pfizer did compared to the market. So until 2004, the market and the Pfizer returns were going head to head. Nothing different. And in those years, this guy was getting $26 million or so from the company. He's okay. He's not bad, right? $26 million. It's fine. After 2004, the markets went up. The economy was really well. But Pfizer returns went really, really bad. Stock price of Pfizer really went down. So what should Pfizer do? fire this guy, right? What happened? He depart, they don't use the word fire, depart in 2006 with $82 million from his pension fund. His total severance package was estimated for $200 million. So he was a bad CEO, but he left with $200 million. So what is the takeaway from the story? Normally, when the CEO is not doing well, bad for the shareholders, bad for the company, he should be punished in a way. This is his punishment, $200 million. Of course, if you're CEO of Pfizer, even if you're fired, you can be a CEO of another company really very easily. And this is what he did, actually. So there is no punishment for that CEO. Okay. So I will see you this Friday. I will let you know which time. We will always meet here, okay? We will be here. I will let you know about the timing.